Academic Topics in Privacy seminar. So this week we are pleased to have Allison Bishop. Allison refers to herself as a partially reformed academic. She has an interesting path through academia and cryptography and into industry and finance, still with an eye toward theoretical and practical privacy problems. So now she is the president and co-founder of Proof Trading, an institutional equities execution platform with a strong commitment to and view of transparency. I stumbled across Allison when she gave a talk at Real World Crypto, which, if you're not aware, is a quasi-academic conference about implementing cryptography in the real world. And we already today had a great discussion about other kinds of real-world privacy and cryptography challenges, both in and out of the finance context. Also, in case you missed it in her bio, Allison is a stand-up comic and was named the 4th funniest person in finance by New York City's Gotham Comedy Club, and I don't know if that's like a really impressive accomplishment or a really low bar.
I was robbed.
Okay, so it could have been higher. So in any case, today Allison is going to be talking about formulating particular aspects of equities trading in the U.S. as a privacy problem. So let's all welcome Allison.
All right, so let me give you just a little bit of background on this. And I'll say at the beginning, I'm not assuming any kind of finance background. And in particular, at my company, the way we do research is we like to talk to academics and computer scientists and teach them finance rather than the other way around. And so I'll try to define the financy terms that I need. If I slip into terminology of finance that you don't know what it means, please stop me and ask, and we'll go back. The intention is for all of this to make sense without any finance background. Okay, and I should say at the beginning, this is also joint work with several current PhD students at City College and other places who work as part-time researchers for us. As a company, we're in a pretty unique position to collaborate with academics because we publish our research. So we let people work with us and publish papers and things like that. So we get good collaborators that way. Okay, so just to give you a little bit of context about this and about me and what my company does, I was trained as a cryptographer. So I did my PhD studying functional encryption systems, which are encryption systems that are not at all functional. So that was sort of a wake-up call coming into industry. I ran a research group at Columbia University for a while, and then sort of wandered into wanting to do more practical things. And most of the motivation for that was coming from the sort of trade-off of being an academic cryptographer and academic privacy or cybersecurity person more generally, that there's lots of good things about that. You get lots of fun research problems, you get an open public culture that you can publish things and talk to people freely, teaching, which I love, a strong community of researchers, etc., and potential relevant to practice. But on the other side, I think from that purely academic seat, especially for people who've never forayed into industry, which I was definitely in that category myself, it's hard to achieve practical impact and to anticipate what are sort of the real bottlenecks that are going to arise when you start translating theory into real-world systems. And the incentives you have as an academic to publish papers are often misaligned with the sort of intensive work that it takes to take a system all the way from theory to practice. And also the problems that we sort of work on sometimes as academic cryptographers or cybersecurity people, where we have Alice trying to talk to Bob, are a little contrived and are not always sort of organically inspired by what's really happening in practice. So I wanted to go and sort of work on things more practical, and it ended up meeting somebody who was running a startup that was a new stock exchange that was profiled in Michael Lewis's book Flash Boys. And he came into the office one day when I was consulting there and asked me what I did, and I said I was a cryptographer. And his 8-year-old son was with him at the time, and he asked me to explain to his 8-year-old son what a cryptographer does. It was not something I was prepared for, and I gave a horrific answer about someone who protects data and secrets and all these things. And Michael Lewis cuts to the chase and tells his son a cryptographer is a person who designs puzzles. And I, of course, like this as a way to convey cryptography to younger people to give them a sense of what it is. But while it describes what it is, it doesn't really describe the why. So it's like, why do any of us work in cybersecurity? We design puzzles, but really, sort of what I believe cybersecurity is, or cryptography is a way of facilitating communication. When I think about what's important to me as a scientist in the cybersecurity cryptography space, it's about making new modes of communication possible, right? It's about giving people the tools to kind of control what they're communicating and with whom, so that we can get better results out of sharing data and out of working together to communicate. And that sort of kind of communication is really needed in the stock market, because the stock market itself is actually a huge distributed system that people are using to communicate different opinions about prices of stocks. And so if you ask an economist or a computer scientist or a mathematician or a trader or an industry person what the stock market is, you'll get a different answer from each person. It's actually a conflation of a lot of different things. So the traditional way to think about it, perhaps historically, was a place to trade stocks. But what it's become instead, rather, is a set of companies that match trades in order for profit. And that sort of profit motive controls or incentivizes what kind of products and what sort of behavior the stock market has. It's also inherently a communication network that is intended to be used for crowdsourcing the value of companies and other sort of related commodities. In theory, in economic theory at least, it's a mechanism for efficiently allocating capital, for putting money towards the uses where society thinks it should go. In theory, it's also an engine for economic growth. And according to a lot of complaints about high frequency trading, which I'll get into a little bit, it's in some sense also a rigged form of gambling. And it is all of these things, right? Like I would say all of these are fair characterizations of what the stock market is. And if you study this problem not as an economist and not as a cryptographer, but just sort of as a person looking at the system from the ground up, you actually see that this is an incredibly interdisciplinary kind of study. So to study the incentives of companies who match trades and how that influences the design and operation of products, there's a lot of game theory that goes into thinking about that. There's a lot of computer science that goes into thinking about the networking of how messages are passed and interact in order to trade stocks. There's a lot of economics that goes into thinking about the purpose and how well the operation is aligned to those purposes. There's also a ton of psychology in the sort of gamification and gambling aspects, and even physics in the mechanisms of how high-frequency trading works. And so a lot of low-level hardware stuff, a lot of speed-of-light stuff, a lot about comparing how data packets travel through fiber optic cables as compared to microwave cables, which is a fun aside that high-frequency trading today mostly goes through microwave transmissions because it's faster than fiber optic, but it gets unreliable when it rains. So there's actually papers demonstrating that stock market trading behavior changes a little when the weather is bad, which is insane. So this is just to give you a sense of, if you come at this problem not from a particular lens of theory, but from sort of first principles, you find kind of all of science sort of embedded in this mess of a problem. And the math, unfortunately for those of us who like math and have fun thinking about math, tends to be the easy part. So this is a logistic regression that I built for the stock exchange IEX to anticipate when a price is in the process of changing across the market. Because the market is not one thing, it's this complicated system. Price changes don't happen as atomic events, they happen as sequences of events across different exchanges, and those sequences often have a kind of pattern or a kind of anticipatability to them. And so you can build little predictive models to say, like, I think someone is going around the market and taking out all of the stock at the best price, even while they haven't finished yet. So while it's still in progress. This is on a time scale of milliseconds. And I'm showing you a formula here not because the details matter, but just to show you that the level of math is not so sophisticated. This is kind of stats 1 level math. It's just basically a linear function of like 8 or 9 things. This little formula predicts about 60 to 70% of this kind of high frequency trading on IEX. You can see this chart of the performance of the formula. Those jumps are where we shipped improvements, where we found new features that sort of made it better. And this little piece of math, I'm also very proud, was the subject of a lawsuit by Citadel. So I'm not sort of named in this, but that's me. inside the Wall Street Journal there with a nice picture of Ken Griffin, who's the owner of Citadel, complaining about the SEC allowing this kind of chaos, right? Like this kind of chaos of a logistic regression being baked into a product of a stock exchange. Citadel sued the SEC over approving this formula to trade on the stock exchange. The SEC won that lawsuit, so some version of this, an upgraded version of this, is still trading today. And it predicts these little things, and it moves people's orders out of the way automatically so they don't get picked off at prices that are in the process of changing. So this is just to show you a little glimpse of sort of what the ecosystem looks like.
So what's IEX?
Good question. So IEX is a stock exchange. So you've probably heard of the New York Stock Exchange. It's like the canonical place where stocks trade. You've probably seen on CNBC or in movies like the trading floor.
Yeah.
Dirty secret about, or not so secret about the trading floor, that's not where trading happens anymore at all. So trading happens in data centers in New Jersey. And the New York Stock Exchange is one of currently 16 exchanges approved in the US that every day, every stock trades on all 16 of those exchanges across the market. And so there's New York Stock Exchange, which their parent company actually owns 5 different exchanges. New York Stock Exchange is one of them. There's a company, NASDAQ, which has the NASDAQ exchange, as well as 3 others or 2 others. It's a company, Chicago Board of Exchange, that owns 4, et cetera. And then there's a few smaller independent exchanges, of which IEX is one. They started trading in 2013. And there's a few others that have cropped up since then. And so basically an exchange is a company that maintains a bunch of servers and software that take in data packets to buy and sell stock and match trades and spit out outcomes. And there's now about 16 different companies doing that service in the US. Other countries have different systems. In Brazil, for instance, there's just one exchange, and it's a public utility. You might have heard of the London Stock Exchange, the Toronto Stock Exchange. Those are also for-profit companies that match trades. There's more than one exchange in Canada. Toronto Stock Exchange is the biggest. So it really varies internationally and based on the rules for what they look like. Exchanges in the US used to be utilities owned by the members of people who traded. And I think it was roughly in the 70s or 80s, they became for-profit companies. And that really changed the trajectory of how they work. Okay. So here's a picture of the workflow of institutional stock trading today. And by institutional, I mean mutual funds, pension funds, places like Vanguard, Fidelity, et cetera, trading big pieces of stock. My particular company doesn't work in the space of retail trading, where it's individuals buying stock on Robinhood. A big piece of that is I don't think that is what individuals should do with their money because of gamification and some reasons that I'll explain as to why you're often getting a bad deal when you trade that way. So we don't facilitate that. We only work in the institutional environment, which is big diversified piles of money that then need to make some kind of adjustment to their portfolios, and that kicks off this chain reaction of all of this kind of trading. And so all the different players here are pictured as different links in this chain. You have an end investor of somebody sitting at Vanguard or Fidelity saying, I think I want to be a little less exposed to tech stocks. Let's sell some Apple this week. And that goes down to a portfolio manager who figures out sort of exactly what sort of percentages and what sort of weights they want on that. That goes down to a trader who's still sitting often in that same company, who's deciding how to sort of send that trade into to brokers. So brokers are companies like us who figure out how to take a big trade, split it up in little pieces across time and across stock exchanges so it doesn't have too big an impact on the price. They interact directly with stock exchanges. And I didn't also mention dark pools, which are like exchanges, except there's fewer rules on them. And there's about 30 plus of them operating today. So there's actually over 46 different places that you can trade the same stock at any given moment during the trading day, which, competition is good, but that seems like a lot. And then we also have proprietary traders who are companies that are interacting with this to provide services like market making, where they try to take both sides of buying and selling so that bigger buyers and sellers don't have to wait around to find each other, and all sorts of other different kind of strategies that they may be running, sort of interacting with this same system at the level of stock exchanges and dark pools. So this is from like a networking and workflow perspective, what this system kind of looks like. This diagram was made by a front-end engineer with a degree in architecture, because that's what it takes to make a schematic of the stock market these days. Okay. Well, let me boil this down a bit to explain the privacy problem that I want to argue is sort of one of the fundamental open research problems in this field that is relevant to, the kind of computer science perspective that I presume you guys are building in this course. And so I'm going to streamline my explanation of sort of all of this into a time series. That's going to give us a sort of relevant context for the privacy problem. And so what we can really think about is we've got buyers and sellers sending in messages to trading venues, to exchanges and dark pools that are communicating some kind of intent of what they want to do and what are the prices where they're willing to do it. And so you have buyers communicating things like, I want to buy 100 shares of something. I'm willing to pay at most some price per share. And other sellers indicating how much they want to sell and what they'd be willing to pay for it. I have, as you may have noticed, changed all the names of stocks to cryptography terms so that no one can accuse me of giving you advice as to what to buy or sell, which I am not allowed to do. So these are all fake stocks. Any collisions with real stocks is entirely coincidence. So somehow all of these things get put into the software of a trading venue who spits out matches where both sides are willing to make that trade. And this is a continuous time series. So this just keeps spitting out trades. There may be long gaps where nothing is happening. There may be rapid fire or a bunch of trades. All of those things are possible. These are usually time stamped down to the nanosecond in terms of precision of when things are happening. And what you get out of this process is a data feed of completed trades. And what everyone in the market basically can see in real time or in extremely close to real time is the sort of record of these trades with all the information except who was trading. So we get to know what time it happened, how many shares were exchanged, what was the stock, which is also called symbol, because stock is actually a more specific term, but we won't go into that level of nuance. And then what is the price per share? And I didn't put it on this table because it's sort of less interesting, but you do also get to see which exchange the trade was matched by. But you don't know who the players are. So you don't know, like, this is, this is Vanguard selling or this is a Robinhood customer selling. You just know sort of what happens. You're just getting the metadata, basically. Okay. But everybody can see this. This is kind of like basically a public data feed, although public in the sense that you still pay through the nose to get access to it in real time. My company is on the cheapest version of the so-called public data feed, and I think it costs us about $17,000 a month. Interestingly, you can actually get historical data for this. So like if you want all the data from last month, you can get that relatively cheaply. And most academic institutions already have subscriptions to that and make it available to researchers, which is very difficult for anyone to use because the exact way to read the data feeds is pretty like insular industry knowledge, but it is generally available to you. Okay. And so I want to set the context for this privacy problem with whose privacy might we be interested in protecting in this public data feed or in this system. And I'm going to do the classic cryptography thing of introducing my heroine, Alice. And Alice, in this case, is going to work for a company that manages all of our retirements. Okay, so that's why we're rooting for Alice. She works for some kind of asset manager that sits on a large pool of financial assets like people's 401ks, university endowments, wink, wink, all that kind of stuff. And her company is selecting a portfolio of stocks, which portfolio is just a fancy word for set, just a set of stocks, that balance risk and reward in whatever way they determine, right? That's an economics optimization problem that we're not going to talk about, but that's kind of upstream of what we're doing. And sometimes the company is going to decide to make a change. So they're going to say, all right, we want to rebalance in some way. We want to sell this. We want to buy that. And since they are sitting on a large pool of assets, these tend to be big in volume. Right, so the amount of stock they're selling or buying is going to be pretty big. And the goal that Alice has, or the problem that Alice has, is to decide when and how to buy and sell these large numbers of shares. Like, how quickly should they trade? How much should they try to get done in a minute, in an hour, in a day? How patient should they be? And what kind of order types, what kind of mix across exchanges should they be using to accomplish this, ideally as quietly as possible? So you have these two things you're kind of trading off. One is you want to move quickly, because there's a reason you're rebalancing. Maybe it's you think the tech sector is going to tank or whatever it is. So you want to try to move quickly. But you also don't want to move so quickly that you basically announce to the market, hey, everybody panic, I'm selling all my Tesla, as fun as that would be. And so those are your kind of inherent trade-offs, is you want to get done, but you want to not cause more impact than you would necessarily need to. And so this is Alice's kind of problem. And she has this large space of choices for how she can accomplish her trading. So she might, for instance, let's say she wants to buy 100,000 shares of CMU. So she can go to the market and she might accomplish this in a bunch of little trades. It's very common on the public data feeds. You will see a lot of multiples of 100. There's this weird notion of a round lot. That is a unit that people tend to trade, and it's 100 shares. So you'll see a lot of multiples of 100. Things that are not multiples of 100 are called odd lots, and things that are mixed in that they're like 132 are called mixed lots, because they just have to have these kind of terminologies. There's also in the midst right now of a huge upheaval of the definition of a round lot, changing from always being 100 to being a dynamic function of the trading qualities of the stock in the last month, which is a nightmare, because all of our units of analysis are now going to be dynamically shifting. So definitely something lawyers would come up with, and all the technologists are hanging our heads like dynamic units are a terrible idea. But that is, for right now, it's still multiples of 100. So a somewhat typical trading behavior would look something like this, where Alice is going in and she's going to be buying shares in multiples of 100, a little bit at a time. And she might be trading against entirely different people. She might be trading against the same person. They don't know and she doesn't know, right? Everybody's just seeing this kind of sequence of trades. And as you may notice, what I did with the prices here is over the sequence, if Alice is buying very quickly in a sort of way that's unusual for that activity in that symbol, the prices might kind of start going up, because somebody might be guessing that there's a big buyer in the market and that they're going to be willing to pay more. And so you will generally see prices going up. Of course, there's a conflation of a lot of things. It's never this clean. There's a million reasons why prices go up and down, and it's never sort of clean to attribute it to exactly this. But this is always the fear, and this is a reasonable fear, that on average, if you're trading too quickly and you're being very visible about your intentions, that people are going to start charging you more and more and more. Okay. So let's think about this from an adversarial perspective. So we had introduced our Alice, we have introduced her problem of that she wants to sort of hide her activity in the stream of sort of general activity of the market. We also have our adversary, Eve. And in this case, Eve is sort of watching this public data feed and trying to guess when a big buyer or seller like Alice is present in the market. And so she might see some unusual sort of clustering of activity in terms of time or in terms of venue, and sort of act in her own self-interest to try to make money off that observation. So if you think there's a big buyer there and you're right, you might be able to sort of trade against them, drive up the price, and make some money off of that transaction. So that's the goal of our adversary, Eve. Now, in some sense, both Alice and Eve are just companies operating on the stock market. Like they're both following the law. They're both just trying to trade in their own best interest. So it may feel a little unnatural for us to be implicitly sort of picking sides in this case. But I would argue the reason that we should generally want to help Alice in this situation is that one of the best ways for ordinary people to participate in the gains of the stock market is to pool our money together into big portfolios at institutions. And this has many benefits compared to like individually trading on Robinhood and things like that. Because one is we can reduce risk by holding a more diverse set of stocks and assets. And also we don't all have to become experts in the mechanics of stock trading in order to avoid being taken advantage of. And we also don't have to rebalance our own holdings constantly, sort of keeping up with the finance news and knowing things like, you know, when it's going to be a big day in options or these other things. Someone else is being paid to do that for us. And nonetheless, we can sort of float along and participate in the overall growth of the market. So these kind of services of putting together a big portfolio can be very useful as a mechanism for participation in the stock market. And if we look at sort of what is happening today in the system to sort of all of our retirement accounts to the kind of Alices who are charged with getting us a good deal and sort of doing a good job for our financial benefit, then what they're doing is they're passing off all of these orders to brokers who are the companies that are supposed to be good at facilitating trading, figuring out how to split trades up over time and space. And those brokers are essentially black boxes who do not disclose anything about how their algorithms work. And so today what often happens is Alice will send off her order to a broker like Goldman Sachs or JP Morgan, who will say like, trust us, we got it, you don't need to know how the black box works. And they're trading on the market against proprietary traders, which are also black boxes that we don't know how to work. And at the end of the day, it's Alice's job to figure out which brokers are doing well, which brokers are sort of getting her good outcomes and good trades, and which brokers are doing poorly and should be trusted with less flow. But it's really hard to evaluate the brokers because the data is very noisy. And so if you compute the level of variance in this data that as a guide for like how many orders do you need before you can tell if two brokers are good or bad, it's on the magnitude of like tens of thousands of orders. Even like big orders. And each individual order might be like 5% of the trading for that stock for that day. And you need tens of thousands of these in order to get pretty reliable estimates of performance because of the level of price movements just in the stock market generally. And each individual Alice at an individual company doesn't want to share any of their performance data with any other individual company. So every single Alice sort of in this picture is completely on their own, using only their own data set to try to evaluate these brokers. And as a result, what's kind of happened is that it becomes more of a check the box kind of exercise. That there's this framework called TCA for transaction cost analysis to compare brokers. And the only thing you learn from it most of the time is whether things are obviously bad or not. And so a lot of times you can tell if somebody's doing a really terrible job, but beyond that, it's very hard to tell. And I should also mention that every single one of these brokers in the system has been repeatedly fined and caught lying to their customers about how things work. So they get repeatedly fined for things like having a secret prop trading desk that trades against their customers. And I wish that were an exaggeration, but that one keeps happening. And fined for lots of things like selling a data feed of their clients' data to other people without telling the original clients and all sorts of things like that. Or trading in their own dark pool, even when the prices are better somewhere else, et cetera, et cetera. So the fact that these are black boxes that are very noisy to measure the outcomes of makes it very hard to sort of evaluate performance. And so the current situation generally is that Alice is paying for these services. So she's paying commissions to these fancy black boxes. There's a shroud of security by obscurity around how they work to protect Alice. As cryptographers, right, we know to be pretty skeptical of this as a detection mechanism. And all of this complexity, of course, gets passed back in fees to all of us in some sense, in terms of our retirement savings, without any accountability as to what sort of value it's adding in terms of performance. And so one of the premises of our startup, and the reason we publish all the research behind our algorithms and all the details behind how they work, is that we think that this is basically exactly the state of the world before people published encryption algorithms, right? Like that how a broker takes a big order and feeds it into the market, it's basically the equivalent of an encryption algorithm. It's hiding the data in the noise of the overall market. And if you're really good at doing that, you should be able to tell people how you do it, and they still shouldn't be able to find it because they don't know what stock and when you're trading. And if you are being obvious and they can find it, then you have a problem anyway, right? Because they could have looked for that behavioral signature even without having known ahead of time exactly what they were looking for.
So like I didn't follow that. So I get like why, encryption works and why it's good to have like encryption algorithms that are disclosed, because they're based on these like mathematical assumptions of hardness. But
Yes.
like you don't really get that in the sense of like just like an algorithm. Like I feel like if I'm like decision broker and I have some like clever algorithm to actually like find out how to like place trades, then if I tell it to other people, that maybe to like a decent approximation, they'd be able to like deploy it themselves, right? Maybe have like more connections and more infrastructure in them, but like that.
Yeah, and we think that would be healthier than what happens now, because right now it's like the argument for keeping it. There's two arguments for keeping it secret.
Yeah.
One is that if you don't keep it secret, people will find you. So that's security by obscurity.
They'll like play against you. Strategy.
You're giving the second argument, which is to keep it secret so that you can monetize it, so that you're incentivized to build good algorithms.
Right. Both.
That assumes someone can measure you and pay you for your cleverness.
Yeah.
Like the fact that your algorithm is good and that means you'll make more money assumes that Alice has enough data to tell that your algorithm is good. Otherwise, you have no incentive to come up with good algorithms in the first place.
Okay. I see that argument, although, okay, maybe it is really hard to measure, although I bet like
now, to be clear, your argument is the prevailing attitude of the industry. You are on the side of many people agree with you.
What about the other argument, which actually sounds stronger than the one I made?
Yeah, so the other argument is, let's say that I tell you, so when I say I'm telling you how my algorithm works, I'm telling you like how I'm going to take a big trade and split it up into little pieces. I'm not telling you like it's a big trade in IBM tomorrow, right? I'm telling you how. And I'm going to randomize some of that, right? And I'm going to look at the distribution of typical market activity, and we're going to get more in the weeds of this in the privacy problem. But there's some kind of ambient randomness in the behavior. And I'm telling you how I'm going to add my sort of own activity in a way that's only going to shift the distribution so far. And I'm allowed to put randomness in my actions. I'm just going to disclose how I do that, but not the randomness I actually sampled. Yes.
The idea is that you can give away the RSA algorithm without giving away your salt, right?
Exactly. So that's the analogy that I'm trying to make. That I'm telling you how the encryption algorithm works. I'm not telling you the randomness that it chose, right, while it was doing it. And let's say, that I tell you how my algorithm works, and you go to the public data feed and the tapes, and you say, aha, this is your algorithm. That's something you could have possibly done without me telling you, if you had figured out what to look for. And the thing is that unlike sort of the math of encryption, where there's lots of complicated like functions and things you can do, there's not that many ideas for how to design an algo. So people do kind of like, there's thousands of people who have had this job of designing algorithms at different places who know the guts of how this code works. So assuming that my idea is something none of them are ever going to think to look for is probably a sort of dangerous. Now it'll slow people down, you would imagine.
Yeah, no, that makes sense.
Yeah, but your argument as to like people can copy it, yes, absolutely. That's kind of what we want as a general society. to move the sort of market in a good way. It may not be what we want as a company, but these things are very dynamic and change very quickly. And so I personally believe that the companies in the long term that are going to win are not the companies who have one clever idea, but who have a good process for generating clever ideas. And we kind of see this in science, right? Like there's not too many one-hit wonders of like theoretical cryptography. There's people who keep generating really cool ideas.
The question is whether we see this in like companies. Like,
Yeah,
I think,
just make sure we get through the talk.
okay, yeah, sounds good. Sounds good.
Move this conversation to the end.
Yeah, that's interesting.
You're
Okay,
good.
yeah.
Yes. All right. I will keep track of. We have till 1:50, right?
We do have till 1:50 officially.
Okay.
Yeah.
We'll try to leave some time for questions. Okay. Yes. So let me get to a little bit more about the math of how this works, because I'm going to make an analogy here. It's different than encryption, but it's more sort of similar to something like differential privacy. And so the way that we think that this kind of works is that the market, let's say without our specific Alice, has some kind of ambient distribution. There's some kind of randomness about how things trade. And so anything that Eve might measure, so let's say there's some kind of metric that she's measuring, like how many 100 share trades were there in a particular interval, or what kind of gaps were there in the timing between the trades, whatever she's measuring, it has some kind of general distribution on a quote unquote typical day. And there's going to be some kind of randomness in this. And I've, of course, drawn something that is a Gaussian style distribution. That's, of course, not always going to be the case, but just as kind of thought experiment. Now, if Alice does something kind of obvious, what that may do is it may move this distribution in a big way. So if Alice sort of adds a huge amount of activity that's going to get sort of measured on this metric, then that might sort of move the entire distribution, let's say, really far to the right. She's like adding activity and we're moving this really far to the right. Now, an Eve sort of measuring this can then sort of view this as a problem of, okay, I'm getting samples from either the black distribution or the blue distribution, and I want to guess which one I'm in. Right? And the farther those distributions are apart, the easier that game is for Eve, right? If they're all the way disjoint, then Eve wins that game all the time, right? If they're more overlapping, it gets harder and harder. So the more that Alice's behavior shifts the distribution, the easier it is for someone to see samples of that distribution and determine whether they're looking at samples from the blue distribution or the black distribution. So this is very similar to often how we think about things in a privacy perspective, that the goal of privacy is to keep the distributions as close as possible, right? To get done what we want to get done without moving the distribution too much, we're going to have to move it a little bit, but we want to control how much we move it, which is very reminiscent of something like differential privacy. Okay. Does everybody heard of differential privacy before? Is that something you guys have covered? Okay. Okay, because we're not going to need any specifics, just kind of the general philosophy. All right, so if we get down to trying to define this more rigorously as a security definition or as a privacy definition, there are some things we would love to be true that just aren't going to be possible. So Alice, for instance, would love to live in a world where the transcript, where the full set of information of trading activity that comes out is the same distribution regardless of what she does. That's clearly impossible. That's a world where Alice doesn't trade. So we can't ask for something that's strong and still have Alice be active in the market. Another economics goal that Alice would have would be for prices to stay exactly the same independent of her activity. Again, not something that's generally going to be possible, because if she's trading a large amount, it is in some sense going to move prices. Because Alice's level of activity represents a significant shift in supply and demand, it's kind of the point of price at the end of the day to ultimately reflect that. It's just a question of how steeply does it change and who ends up on the losing end of that sort of process of integrating that information into price. So what we're going to hope to achieve instead is to measure the distance between the distributions and to try to minimize that subject to completing the trades we want to complete. So Alice wants to live in a world where the distribution with her trading looks similar to the world without. So if she can choose two different ways of accomplishing her goals, and one of them moves the distribution by a little and one of them moves the distribution by a lot, then she wants to choose the one that moves it by a little. And so this, of course, is very dependent on defining what is the suite of measurements that Eve is going to take. And so we have to, and I'm going to talk about this at the end, is sort of the one of the biggest open problem spaces that we're working on now is sort of going after real trading data and finding what are the different useful measurements that Eve can make that therefore should be built into defenses. Okay, so this is kind of the goal. And we can define this as a formal sort of security game. So in the formal security game, we have some ambient distribution of market activity. Everybody knows what that distribution is. So everybody can sort of do their own sort of data science and figure out what the distribution is supposed to be. And maybe there's also some auxiliary information that Alice has as she herself is monitoring the market and seeing what's actually happening in real time. So we have a sort of auxiliary term that's meant to model that. But the most important thing is that Alice is going to take an action. So she's going to decide on some amount to trade and some way of trading. And let's say that trading gets added to whatever randomized process the market was doing anyway. And what spits out for Eve is the sum of those two things. Now, having it literally be a sum is a little simplistic. It could be a more complicated function, but just for illustrative purposes, let's keep it as a sum. And now what's going to happen is we can repeat this over and over again. So maybe this is a measurement that Eve is making every 10 minutes, every trading day, et cetera. We're going to play this game over and over. And each time Alice gets to make a new decision about what sort of term she wants to add to the market activity. And every single time, Eve is going to get the outcome of whatever the market was going to do without Alice plus that added activity in. And the goal here is to balance utility and privacy. So the utility goal is that Alice has a certain amount of trading that she needs to get done. So we want to maximize, let's say, the amount that Alice can trade while staying within a certain privacy bound, where the privacy bound is on how far the distribution can move. So what is the likelihood of an individual outcome in the world with and without Alice? We want to control that sort of gap. And we want to trade as much as we can within that gap. So we're going to fix some kind of privacy threshold of like, we don't want to make any sequence of measurements for Eve, let's say more than 10% more likely or something like that. And then we want to maximize our trading inside that threshold. This becomes a pretty natural optimization problem. We're trying to maximize the expected amount that we can trade within the probability of each measured outcome or set of measured outcomes in the repeated game, staying within those sort of privacy bounds. And this can be solved as a linear programming problem. So we can just explicitly set out all the probabilities of the ambient distribution, and we can sort of pick our privacy parameters of how much wiggle room around those probabilities do we want to give ourselves. And we can just solve for an optimized version of Alice in at least the one round setting. And here's what we tend to get out of it. This is an example on real data. So you can see how noisy the sort of measurement that I've chosen here is on the real data. So the blue is what the market looks like generally. The orange is sort of a really high privacy cap. I think I use like e to the epsilon being 2 here, so letting everything be twice as likely, just so you can kind of see it. And the red is what the linear program spits out as the distribution Alice should aim for if she's trying to maximize what she can add while staying under that cap. Now, of course, if you're doing this for real, you would smooth these distributions first. You wouldn't sort of like assume the real distribution has this kind of spikiness to it. You would sort of model it more smoothly. But I wanted to show you the level of noise so you can internalize that a little bit.
I don't understand what the axes here represent.
Good, because I didn't say.
Yeah.
And that's because the set of things that Eve would actually measure goes pretty in the weeds of stock market mechanics. And so the thing that I was actually measuring here was something that I call volume pressure, which is how much of the stock is trading at like a price higher, like, so at any given moment, there are buyers and there are sellers advertising prices, and there's a gap between those prices, because if there wasn't, they would just trade with each other. So you have this thing called the spread, which is the gap between buyers and sellers, and it moves around dynamically throughout the day. And when you have a bunch of trades going off like at the high end, it means you have a bunch of buyers who are coming in desperate, and they're just meeting the price of the sellers. And then sometimes you have a bunch of trades going off at the low end. It means you have a bunch of desperate sellers who are like, okay, fine, I'll take what the buyers are offering. And so you can measure the balance between those things as an indicator of like, who's more urgent, the buyers or the sellers. And so I have my own kind of normalized flavor of that measurement, which in some very strange units is my x-axis here. And so it's measuring the sort of imbalance between the trading activities at the low and the high end, which is very sort of like precise and complicated to explain. And then the y-axis here is just the probability of that measurement over the data set. So it's saying like, I took a bunch of stocks trading over months of data. I measured this every 10 minutes. And I said, how often, just built the histogram of like, how often do I get this measurement versus that measurement? Other questions?
Why is the Alice line so smooth?
Because it's the output of the of the linear program.
Okay.
Yeah. Yeah. Other questions? Okay, so that is sort of the framework that we have so far, and we have this in a paper that you can read the PETS version, but don't read the one on our website because the reviewers made me make it worse. So I left up the good one on our website. But this leaves this is really just kind of like the beginning of a phase of research rather than like we solved the problem. Like we basically showed that one little piece of the problem is solvable. For one thing, we don't have optimal solutions to the multi-round game. So my linear programming solver works for 1 round. It works for 2 rounds in a week. It does not continue working beyond that point. We do not have a polynomial time optimizer for the multi-round game. That's kind of an obvious one to do next. There's often, as with every privacy problem, there's this really thorny question of how do we decide what the privacy cap should be, right? So there's a lot of practical considerations there. The really fun open problem that we're working on next is how do we decide what sort of things to model from Eve's perspective? Because if you try to model everything, then you just get immediately swamped and you can't make any progress. Because every single thing Alice does in a continuous trading environment is a special snowflake of a trade that only exists because Alice did it. So you can't have these kind of satisfying computational indistinguishability kind of definitions because like everything Alice does is technically unique, right? Every transcript of information is technically unique. So you can't say things like the probability of this exact transcript being produced without Alice. Like it just doesn't make sense. So you have to pick some discrete set of things that Eve's going to measure and sort of have a contained distribution on those things, which means it really matters how well you can play the role of Eve, which is really fun because you can then work from Eve's perspective and try to find patterns in live trading data, which is a really fun thing to do. And so that's what the phase of the problem that we're working on now. So I want to give you just a little bit of a preview of that work, which is a very different sort of problem from the privacy perspective and the optimization problem, which is this is more of an unsupervised learning problem. Because from Eve's perspective, you don't have any ground truth as to who's actually trading in the market. You don't actually know these trades are one Alice sort of doing her thing and these other trades are something else. You don't have any of that. So you sort of fundamentally have an unsupervised learning problem. You're just looking for structures, right? And you get to define what structure means. And so there are some classic tools in the unsupervised learning space that we have for addressing problems like that. things like clustering, distribution testing, hidden Markov models. And I highlight hidden Markov models here because they have a nice way of capturing the element of time. And so just give you a quick primer on what these are and why these are extremely relevant to Eve. Markov models are probabilistic models of processes that have states. They look like finite automata. They have states. They transition probabilistically between the states. So you can define a Markov model like this. It has 3 states. It has different probabilities of what state it goes to next. And the only memory it keeps is what state it's currently in. And so based on where it is now, you have some distribution on where it goes next, et cetera. So hidden Markov models are where you have that happening under the hood, but all you get out of it are some samples of distributions that exist in those states. And the example I like to use for this is sort of a cranky judge presiding over a courtroom. So you may suspect, for instance, that the judge presiding over a courtroom gets hungry before lunch and therefore starts giving out very mean sentences, but you won't explicitly know that, right? You'll just see some kind of outcomes like guilty, guilty, not guilty, guilty, et cetera. Maybe a good model of what's happening under the hood is the judge is transitioning between these 2 states of chill and cranky. And when they're in a chill state, they're more likely to acquit. And when they're in a cranky state, they're more likely to convict. And a hidden Markov model is a way of finding the best underlying representation that explains the data sequence that you get. And so kind of like clustering, we have to define what it means for the model to do a good job of fitting our data. And in this case, it's going to maximize the probability of observing the sequence you observed. And so if you have sequences in this case where the not guilties tend to cluster together and the guilties tend to cluster together, you get a 2-state model like this that would do a better job of explaining your data than a single state model which just independently picks every time, right? So it sort of explained that kind of like clustering correlation kind of property. Now, the analogy I want to make here to the stock market and to Eve's problem is that this is kind of what's happening in the market as Alice or buyers like Alice or sellers like Alice are coming in and out. That they're going to create some kind of tendency to change the distribution. It's going to be active for a while, and then you're going to transition out of that state. So your measurements from Eve's perspective are going to be some sequence of outcomes of like quiet, heavy activity, a certain kind of activity, waxing and waning. And you might have these kind of states happening underneath of big buyers and big sellers entering and exiting that sort of control what that ambient distribution looks like over time. And so things like hidden Markov models, I think, are going to be a good tool for capturing this tendency to cluster in time of different distributions sort of coming in and out at the market. The states for hidden Markov models may be a little too simplistic because we're having all these buyers and sellers kind of overlaid on top of each other. And if every single combination of them is a new state, you get a combinatorial explosion of states. So I think we're going to need to modify it a little bit to have sort of our notion of state be the presence of somebody and then allow those things to come in and out sort of independently. But in general, I think this is a really interesting space, sort of unsupervised learning, to define what it means to find patterns in this and then to build that back into defenses and take that back to the sort of privacy framework and say, how do we design trading behaviors that stay under the radar of these kind of patterns that exist in real data? And so that's kind of the research agenda of what we're doing. And I should mention, I would highly suspect that absolutely none of this is new research. All of this was probably discovered in the 80s by high-frequency trading firms, but none of them have published it. So I still get to be first. And I think and one reason why we should think that all of this is possible, that this is a fruitful area of research, is there are people making tons of money off of finding signals and trading data all the time. We just don't know how they're doing it. And so it's a really kind of interesting sort of subfield of research that you kind of get to cheat and know that there's stuff to be found. Like there's plenty of stuff to be found. But there's also like no literature you have to comb through in order to cite and sort of be unique compared against. So it's kind of a very fun sort of playground. You might wonder, of course, why is nobody else doing this? And the answer is that it could make a lot more money if you don't publish it. But at the end of the day, like Alice kind of works for all of us. Like she has all our retirement accounts in that framework. And so this is research that we sort of believe should be happening in public, ideally, at least as a complement to the research happening in private. So that's the sort of problem space that we're working in. And yeah, I would love to talk more about any aspect of this and take questions.
Pretty immediate one. At the very start, you showed an article where you got some pushback from Citadel.
Yep.
Has that been a pretty reoccurring theme in this case? Because if you're trying to unmask what people have been doing for a very long time, I have to assume people are very angry.
Good question. So yeah, when my business partner and I used to work for IEX, he was one of the co-founders there. IEX was sort of more directly in conflict with Citadel in the sense that when IEX made changes about how they match trades, it directly impacted the profitability of Citadel strategies on IEX. As a broker, we're not sort of like directly in conflict with them in the same way. But in the longer term, like if we were super successful, the hope might be that some of their ways of making money are less effective against the Allisons of the world. But we're too small at this point for them to notice. So that has not been a recurring theme. Citadel suing the SEC over things they don't like has been a recurring theme. That was my only guest appearance so far. Yes.
Yeah, can you go back to the slide with the Gaussian distributions of Alice?
Sure.
Okay, right here.
Yeah.
All right. So it seems to me what the system is doing is it's saying, so Alice has to sell 100,000 shares of CNU.
Yeah.
And what it's going to tell her is how many shares and at what price she can sell without disturbing the distribution within the privacy bounds.
Yeah.
Okay. So it tells her you can sell 200 shares at $400.01. She's way off her target of selling 100,000 shares.
Right.
So this is you go through the process again, you repeat it. So it may take her a very long time to unload all this stock without people realizing what's going on.
Well, yes, it may. It depends on how you set your privacy bounds. There's also like a dual problem here. So you can say like, I want to fix a privacy bound and I want to trade as much as possible. There's a dual version of the problem that you can also solve efficiently for one round, where you say, I want to trade as much as possible. Tell me what privacy bound I can stay within. And it also depends on like how you're measuring that and how you're defining it. But in general, so like the sort of models that we have built of trading behavior seem to imply most of the time, pretty robustly, no matter what metric we look at, that if you try to trade more than sort of 10% of the average daily volume of a stock, then you tend to go outside the range of typical behavior. So there are often orders that last months. So like it is common in the industry for someone to trade, to be 5% of the volume every day for a month or 2 months. There are other people that might be comfortable sort of having more of an impact and trading. An aggressive order might be 30% to 50% of the average daily volume in a particular stock. But some of these orders will take a really long time to complete. Which goes back to the like, how do you pick the trade-off bounds compared to like the opportunity cost, which may depend very specifically on your hypothesis for why you're making that move and what kind of time horizon that hypothesis corresponds to.
It sounds like a GAN would really do something good, because what you're trying to do is engage in a pattern of activity that cannot be detected by the logic. And then you're trying to develop a detector that's trying to find these trading patterns people are engaging in.
Right. Yeah, the problem with whenever you get to fancier models, the noise tends to make them overfit pretty immediately. So you have to do a lot of pre-processing to pare it down to sort of make them work. But yes, that is the way we're thinking about it. Yes?
You publish the mixing algorithm for trades. It's public, everybody can see it. But where do you get the randomness? Do you publish the source of randomness?
No.
Where do you get it from? Is it a quantum random number generator, or
it's not that
is it
fancy.
software?
It's a software generator.
I see.
Yep. Yeah, I don't remember the exact specifics. Our trading system runs, and we also publish a bunch of things about the company in terms of like company structure, company history, like financials. We published a full description of our tech stack and like how our platform works. Our tech stack is written in Java and runs in AWS. And yeah, we're generating software randomness within Java.
So that's, you concentrated the risk in the goodness of the random number generator.
I would say also though, like, that's not the only source of randomness in the sense that like your trading behavior is also a dynamic response to other things happening in the market. So you're also constantly feeding in the randomness of other people's behavior. Of course, that is something other people can see. So like there is an interesting sort of back and forth there. This is not quite the rigor of an adversarial environment of like cryptanalysis because the noise is so high.
So from the Eve's perspective, is she targeting a specific user, Alice, or could it be like anyone who's putting?
She probably doesn't care. She's just looking for a pattern that tends to be correlated with price or that she can make correlated with price based on how that person would respond to what she's doing. And she doesn't really necessarily know. She's never going to have ground truth on like who that trader is. As I say it, that's not perfectly true because at the end of the day, like after you make a trade, so like in real time, you know you traded, you don't know who it was, but like at some point the stock has to change hands. And so at the end of the day, like you do learn where, if like you're buying stock, like your like custodian who holds your account has to talk to the other custodian who holds their account, and like the stock has to go from one account to the other, and the money has to go from one account to another, which is called clearing and settlement. And at some point, you have to like exchange numbers, like while that's happening. But it's a day later, and it tends to be, you know, like obscured in the sense of like lots of different hedge funds do their banking at JP Morgan, and you'll be facing off against JP Morgan, and you won't know more specifically which customer, et cetera. But there's some additional leakage in the clearing and settlement process that I'm kind of ignoring for the purposes of this. Yes?
Kind of to pivot to a new topic, more about like your personal background. You started off in like photography. Can you like elaborate a bit more about like your background in like finance and the stock market at the time and how you made that switch?
Yeah. This is a story that sounds made up. But I promise this is what happened. So in 2014, I was a first-year assistant professor at Columbia doing cryptography stuff. And to be clear, like I kind of hate finance. So like I once interviewed for a finance job when I was in grad school at D.E. Shaw, like for a summer internship, and I got turned down and accused of cheating in the interview because they asked me a brain teaser question. And they said like, "Have you heard it before?" And I said no. And then they gave me the question, and I said, "It's N choose 2." And they said, "You've heard it before?" I said, "No, I have a degree in combinatorics." And I got accused of cheating, and I did not get the job. So I was not interested in finance, like, at all. But I went to Fox, the Foundations of Computer Science conference in 2014 in Philadelphia to give a talk about software obfuscation, which is not practical and does not work. Don't use it. And while I was there at the same time, there was a Forbes 30 Under 30 conference, and I was 29, and I had made the list. And the event happening the night before Fox was a pub trivia challenge hosted by Monica Lewinsky. And she was awesome. Like, she gave a talk at the conference about cyberbullying and stuff that was amazing. She's very cool. And so I went to the pub trivia challenge, and I was on a randomly assigned team with this guy, Dan Azen, who is a character in the Michael Lewis book, Flash Boys. And we just ended up talking, found out we both lived in New York, and we became friends. And for about a year, we were hanging out, and I was complaining to him that academics work on pointless problems. And he was complaining to me that he didn't have anybody to work on this kind of like machine learning problem they had at IEX about modeling these price changes across the market. And so I came in to do some consulting for them. and basically learned from them all of the sort of financy stuff. And so it took me like 3 months to sort of get up and running, to learn like what all the terms for everything is, like how stock trading works, like what order types work. Before that, I couldn't have told you, like I couldn't have named a stock except for Microsoft, because I worked for Microsoft and they gave me some stock. And I was like, what is that? And they tried to explain. So I definitely got into it from people who think about it much more in a computer sciencey kind of adversarial way, because they were mostly a mix of computer scientists and stock traders. Which the interesting backstory of IEX was that my business partner Dan graduated from Stanford in 2009 and went to work for RBC, the Royal Bank of Canada. And at the time, he wanted to be a human trader. Like, he wanted to be one of those people running around the floor going, like, give me so many shares of something. And right before he was to start, like the week before he was to start, the guy who would have been his boss, Brad Katsuyama, who's the main character of Flash Boys, got moved over from managing the human traders to be in charge of the electronic trading, of the algorithmic trading, which is a weird choice because I don't think any person in tech would put a non-tech person in charge of inventing the electronic trading at RBC. But so he was like, well, I have this new guy who has a computer science degree from Stanford, so I guess he can do it. So as a 23-year-old, Dan sort of spent his days at work sort of sitting with Brad, where Brad would tell him the human way of doing something and Dan would write it into code. And so the algorithms that are trading for Royal Bank of Canada are built on top of the code that my business partner wrote in roughly 2010 that sort of do that. So that was like how he learned the business. And then when I came into IEX, I sort of helped them with the more data sciencey part, but they taught me about all the mechanics and all the politics about how sort of networking and all the systems work. So a lot of times the only way to like get really into the granular of how these things work is to basically sit with somebody at one of these companies and just sort of ask them a bunch of questions. It's really hard to get good information on the outside about how these things work, which is another reason why something that we've done on our website is publish a bunch of explainers about things like this. So I wrote a primer on the stock market structure, just like what are the different companies and what do they do, because that was my own process of like learning that. And so we're trying to make, and there's some other resources out there like that too, but there's really no substitute for just sort of like sitting next to someone doing it. Yes.
So I understand that there's kind of this like Alice Eve problem with, okay, you can detect that somebody is making like buying a lot of stock and then we're going to jack up the price and like basically hurt people retirement funds, right?
Right.
You also mentioned the issue of brokers and black boxes. Is this like somehow connected? Like, are you addressing that problem as well?
Yeah, so I good question. I would say these are related in the sense that it's the broker's job to protect Alice from being exploited and detectable. And if the broker is a black box who's not held accountable or incentivized to do that, then what you'll get is bad outcomes for Alice. But it's basically Alice's protection from this kind of phenomenon is at the broker's discretion. Like they're the ones actually trading on behalf of Alice in the market. And so like this is the problem that the broker is supposed to solve for Alice. My argument about the black boxes is that the system that we've set up, or the conventions that we set up, where they get to be a black box, is not setting them up to do a good job to solve this problem for Alice. Other questions?
Trying to take this in other domains, could you apply similar concepts to something like web fingerprinting, right? Like you're pushing the envelope for as far as you can get without sticking yourself out and making yourself known? Like
maybe. Like, I mean, there's definitely a generalizable part of this, which is just a continual interactive system where you have privacy concerns, right? And the sort of game that I defined here, like where you have some kind of distribution and you have some sort of repeated measurements, that doesn't have anything to do with stock trading in particular. Like this is just like an information theory game that you could apply to different settings. I don't, off the top of my head, have another sort of good out-of-the-box application for it. But yeah, I think it's fair to think about in a more general context.
Okay, I think I'm gonna call it here, so let's all thank the speaker again. Hopefully Allison's willing to stick around for a couple minutes in case anyone else wants to come up and ask questions. And just as a reminder, if you're registered for the course, please put your name on the thing.
Yeah, there you go.
Oh, yeah.